read, but now you have. Is that a correct statement? Then everything I talked about last time still doesn't make any sense. It's intermediate accounting, so that's all. So, anyway, be all right. I think we were talking about discontinued operations and non-controlling interest and all that stuff, remember last time? Extraordinary gains and losses, discontinued operations. Anyway, there's a really nice chart on page 177 that lists everything. Have you noticed that these blue boxes are really, really useful? They lay it all out there. So what you can do is you can look at that and then ask yourself, do I understand virtually everything that's here, and could I answer and ask a question related to it? Could I work any sort of problem related to it? And if the answer to either of those questions is no, go back in the chapter and dig some more and work some more problems. Does that make sense? So just see what you got. Anyway, so here we go. If a loss is unusual, a gain or a loss rather, it's unusual, right? So, by the way, is this operating or non-operating stuff? We're already non-operating, right? Operating is in the normal course of business, right? When we're in business to buy and sell, right? Okay, so that would be revenues, cost of goods sold, operating expenses, right? All that stuff, and then income taxes on that would all be considered operations, right? Okay? All right, but then what about non-operating stuff? This is still before income taxes, but you could think of it separately, right? What do we have? Gains and losses and other revenues and other expenses that you don't think are from operations. They're peripheral to the operation. You guys already knew that, didn't you? Okay, so just let it become part of your toolkit, part of your knowledge set. So each thing you see isn't something new. It's just added to what you already know, right? It fits, okay? It all belongs in the structure. And that structure is just debits equal credits, assets equal liabilities less equity, right? Revenues less expenses. I mean, it just is, right? So how does all this stuff fit? By the way, you might think that sounds really basic, but I don't think it does. I have an idea of what we have to do to get to a point with a Fortune 500 company of actually having a balance sheet and having an income statement. It's a tremendous amount of effort and a lot of thinking, a lot of judgment, right? So yeah, it's all about doing a balance sheet, income statement, cash flow statement, all the notes, but that's a big job, right? It's horrendous. And it's different in different industries that you read about, right? So, it's what it is, so let it be that. Okay? And at the beginning here, then you have a framework to put it in, don't you? Okay? That's all. Anyway, so not considered extraordinary. It says the criteria, material. What if it's not material? What would you do with a gain or a loss if it's not material? What's the answer to that question? It's not material. It would not affect any decision maker, right? What's materiality? It would change your decision, right? It could change your decision. Investing decision, a reasonable financial statement user, reasonably informed financial statement user. Because remember, you're not preparing financial statements for people who don't know anything about financial statements, right? You have to know what an asset is, a liability is, and so on. You don't have to explain that into a financial statement, right? So they need to have reasonable business knowledge, right? So, what do we mean by material? It would influence a decision. It could influence a decision. Instead of investing in stock, I don't. Or instead of not investing, I do. That's influencing it, right? Selling stuff to the company, buying stuff from the company, going to work for the company, right? It might change what somebody would do. And if it's big enough that it reasonably could, what would you do? You consider it material. If it's not that big, what do you do? It's not material. So what percent is material? What percent of net income is material? I don't know. Depends on the situation. What percent of total assets is material? I don't know. How about if net income is 0? What's material? That's a tough one. Any additional expenses or an increase in expenses or reduction of revenues puts you in a loss position. People could really react to that. Oh, going the other way could put them in a gain position. People could really react to that. What if your income's pretty large? Now, it might be a pretty good percent of income, right? Could be 5-10% income. It might be a big number. So there's not a number that's material. You got the idea? By the way, if the journal entry only affects the balance sheet, debit an asset and credit a liability, say, right? Fail to record an asset and a liability, right? Might you have a different scope for materiality on that than if it debits an asset and credits an expense? Or debits an expense and credits an asset? Oh yeah, because the one hitting the income statement does what? Either a revenue or expense, right? Hitting just a revenue or expense. Not both. If it hits both, it doesn't change net income, right? Lower scope for materiality. If it only hits the balance sheet, it doesn't change net income, does it? Get the idea? Might not even change total assets, but debit an asset, credit an asset. Got the idea? But how about if you're going to be on hitting the income statement and the balance sheet? So it's going one side's to one side's to the other. That's probably the lower scope for materiality if you're changing income. Got the idea? So when we talk about materiality, it means something, okay, guys? Right? We talked about this a little bit before, right? The author talked about it, I talked about it. But you got to really get this down, ingrained in your mind. Okay, so it's material, right? And it's either unusual or infrequent, but not both. If it's material and it's both, what do you have? Yeah, and material. That's extraordinary. And where does it go? After net income. So continuing operations, right? Guys? Where do these go? Before net income, continuing operations, and before tax then, right? By the way, everything is after net income and continuing operations. We have to show it net of tax, don't we? Why? Because we already took the tax expense out of the revenue expenses from operations and from non-operating stuff, right? Whatever you have up above. So anything's down below, of course it has to be net of tax. How about the things we're going to talk about that are on the retained earnings statement? They have to be net of tax if they have a tax impact, right? Which they typically will. If you go back and restate depreciation in prior years, guess what? You know, you made a mistake, right? In prior years, you restated, maybe. Is that going to change your income tax returns for the prior years? Of course it is. You either have more or less income in those years, and you're going to have to recompute the tax, refile an amended tax return, aren't you? So if it's a loss, it's going to get you a tax refund, isn't it? So wouldn't it be the loss less the tax refund? The tax benefit? Sure. If it's additional income you have, now what would it be? Gain or more revenue or whatever, right? More income, right? That's going to increase your tax. You're going to owe more tax. So of course it'll be net of tax. The fact it's on the retained earnings statement, so what? Everybody good with that? Okay. Not a big deal, but it's what it is. All right, so they give you some examples. Write down receivables, inventories, adjustments, pre-contract values. You know what I think? You can read through this. I think that it's anything that you did not make happen yourself, and still it's unusual and infrequent. The bar is real high on this. Most of the world doesn't have extraordinary items for it to be unusual and infrequent. Both the bars are real high. Most countries don't bother with extraordinary items. I think, I probably told you this in principles, I think if you build a restaurant on the riverside of the flood wall downtown, and you get flood damage, you know what would happen, right? They close the flood wall, the water comes up, and all those restaurants that are on the riverside of the flood wall, they know that they could have damage from flooding. Usually what they have is in their basement's not a basement, is it? Like at Kingfish, the basement's not a basement, they have picnic tables down there. If it floods, they lose their picnic tables. They don't lose part of their restaurant. And the top floor, you know what it's even with? The flood wall. You walk in there, look across. It's right even with the flood wall. What's going to happen if there's a flood? The water will go over the flood wall and won't go on their first floor. Although, you know what? A barge would come down and run into the restaurant and destroy it. It still would not be an extraordinary item if that happened. They're taking the risk, right? How about if you're on the other side of the wall? What's over there? That one that loves to, it's the bar that has the women in the tight shorts, tight t-shirts, Hooters. Yeah. They get sued every once in a while by their employees. It's bizarre. You took the job. Don't go to work. Yeah, anyway, and if you think it's totally inappropriate, crying out loud, don't go there. Why would anybody go there anyway? Their food. I went there once with a bunch of freshmen. No kidding. I had a freshman focus class, and that's where they said they wanted to go. And it was 70% young women. The 18-year-olds. Are you kidding me? You want to go to Hooters? So I said you go anywhere you want, right? Oh yeah, they're supposed to have great wings. They couldn't even drink. Why would anybody go there if you couldn't have a beer? And their beer is awful, right? So I didn't have any. I was with 18-year-olds. But you know, I went in there and it's got the beer list is awful. The food is awful. You know, this is a ridiculous place. What a business concept. And it's packed with guys that are young, right? Testosterone, I guess, acting or something. Yeah. Anyway, so what if they get flooded? They're on the other side of the flood wall, right? They're on the second floor on the other side of the flood wall, aren't they? I think so. I think it is. I used to live over there. I think it's right above. Yeah. What if they get flooded? I think that's an extraordinary item. How far apart are those businesses? All right, less than a block. Got the idea? Okay, so it depends on what risk you're taking, what situation you're in. I think if you start a business right now in Afghanistan, and the government expropriates your property or gets destroyed in a war, I think that's not an extraordinary item. I think if you start one in London, and that happens, I think it probably is. What do you guys think? You know, what are the odds? So it's looking at probabilities. Okay, so extraordinary item is really, really a tight issue, and most countries just think it's silly that we do them. It's one of the things we like to do. Okay, anyway. So, what do you do with these things? It says placed on the income statement on the unusual gains or losses. In a separate section, that's not operating, right? Often reported as other revenues and gains or other expenses and losses, or both, I guess. Not shown net of tax, of course, because income tax comes after it. Discontinued operations goes through what we did last time. Dispose of a component of the business for which the company can clearly distinguish operations and cash flows from the rest of the company's operations. Judgment call, right? What if I'm in all 50 states and I get rid of one state? I'm selling all 50 states and decide not to sell in one. Extraordinary? I'm sorry, discontinued operation? All my sales in one state I just discontinued. I don't know why, but I do.
Depends on the state.
Oh, it depends on the state. Oh, the state's Wyoming. Who cares? Right? It's almost nothing. Right? The state's New York. Or California. Or Texas. I bet it really matters. It depends what your sales are in those areas, of course. Right? But I bet it would matter. Got the idea? So you have to look at how big is it? How material is it to you? How important is it to you? And is it distinguishable from everything else? I think the example I used was one type of potato chips going, big deal. All your potato chips going, right? You have 20 different kinds. You're not going to sell potato chips anymore. That might be a discontinued segment. I'm not sure what or not. Maybe it'd have to be all your chips. I don't know. Depends on judgment, right? So you need judgment to determine how you disclose things? Yes. If people have different judgments legitimately? Yes. One of the difficulties with financial reporting, of course. Okay, it's not just a bunch of rules. Oh, by the way, when you get into on index class, he's going to refer to generally accepted accounting principles as rules because he just wants them to be his personality type. He wants them to be rules. They are not rules, they are principles. In the United States, we tend to treat them as rules. So he's right about that. And we think we are supposed to follow them blindly. Whether they give you full disclosure, good disclosure, tell people the truth or not. Are you supposed to just blindly follow GAAP, or are you supposed to decide whether or not you have fair disclosure? We want fair disclosure. In Europe, they claim they are principles-based, and they claim we're rules-based. But I've studied international financial reporting standards quite a bit. We were teaching it for quite a while, but now that it's merging, we don't teach it separately anymore. It's getting to be all the same thing anyway, right? So it's not as important to learn about financial reporting standards now because international financial reporting standards, because they're not really different than U.S. reporting standards, right? They're getting much closer. And I do identify where they're different, like this extraordinary item thing, like LIFO versus FIFO when we get to it, right? Doing inventories. But I don't know what I was going to say. Oh, they think they're more principles-based, and they think we're more rules-based. We kind of agree with that. But there are instances where the reverse is true, where they have very detailed rules for how to account for things, and we have kind of general guidelines. But for the most part, they tend to have more general guidelines and use your judgment, and we tend to follow rules, or we like to follow rules. Americans like rules. We like to think we're free, but we don't really like to use our judgment. We want to have a rule. Why do we have speed limits on roads? Wouldn't you think people would be smart enough not to go 100 miles an hour, on a city street? I never know what the speed limit is driving around town. You can tell what the speed limit should be, of course. There's cars parked on both sides of the road. There's not room for two cars to get through. Do you think it's 50? Do you think it's going as fast as you can, possibly, and hope to die and kill kids and stuff, versus you're out on the freeway? Do we really need speed limits? Oh, in the U.S. we do, right? In Germany, not so much, huh? Right? The 4. Use your head. Although there are free people in this country, too. I just mentioned Wyoming. They don't have speed limits on most of the roads. What 4? There aren't any people there anyway, right? You know, so, okay, because you speed, wait a minute.
I'm speeding, trying to get here on time.
Yeah, see there, and you go with the speed limit, you can go twice as fast. Yeah. Okay. All right, anyway, guys. So it's kind of an interesting argument, and we'll talk about that as we go along. Okay, how do you handle the disposal? Oh, by the way, what order do we go with? You get, after you get down to net income from continuing operations. Envision this income statement. What does it look like, by the way? You guys tell me. Let's do a real quick income statement. You know, company name. Where'd they go? I know I just had it, didn't I? Thought I did. You got a company name up here? For a period ended, maybe a year ended, month ended, whatever, and a date. Right, guys? Okay. Oh, should have said something before that. Income statement, right? Okay, so a company name, income statement for the year ended. Okay, good. What do you start with? Operations. But what would it be? What would it be first?
Revenue.
Revenue. So all your sales, service revenue, whatever. Then what comes for it? If I am a, so this would be sales. If I'm a merchandising company, I sell merchandise. Either a manufacturer or a merchandising company, what would come next? Cost of goods sold. Major expense account. Then what comes? So you could create one of these, couldn't you? Then what comes? Operating expenses. All kinds of different operating expenses, right? General administrative expenses, marketing expenses, research and development expenses, whatever you categorize as your operating expenses. You take operating expenses away from gross profit, what do you have?
Operation.
This is operating. Get it? Okay. Might it be net income before taxes in some companies? Absolutely, if they don't have anything below there. Got the idea? Okay, so good. Then what comes? No, there it is. Selling administrative or the operating expense. Oh, non-operating. Oh, gee, this stuff is all operating. And now why don't we do a section for non-operating? What do you think, guys? You don't have to memorize it, just makes sense. Health, okay. So what do we have in here? What goes in the non-operating? You might call it other, gains, losses, what else? Revenues, expenses. Only use the names you need, huh? Or you just call it non-operating stuff, right? Not the word stuff, but non-operating. Okay? And then, so what you do is you have some increases and some decreases, right? Gains increase, revenues increase, losses and expenses decrease. This is all the non-operating stuff that doesn't belong up here, huh? And then what does that give us? So here we have income from operations or operating income, and what's the next thing? Income from what? No, I'm going to add the operating income to the non-operating to get the new total. You can have total non-operating if you want. And then you could add, so we could put that in here if you want. Total non-operating. And then we could add the non-operating here to the operating. When you add the two together, what do you get? Income from what? You guys don't know this yet, do you? Income from what? Anybody? Continuing operations. Okay. I said you read the chapter, and I talked about it last time.
Could it also be where you put income before tax?
Oh, it's income from continuing operations before tax. It absolutely is.
Is it okay if you just put income before tax?
You can call it income before tax if you have no what? Discontinued operations or extraordinary items. If you do, you have to call it income from continuing operations, or income before extraordinary items, or income before discontinued operations, or income before both, right? You have both, right? Yeah, and yes, you would say before tax. Good question, yeah. So it's income from continuing operations. Now here's the unfortunate thing. We have used the term operating income, and then we use the term income from continuing operations, and they sound just like each other, don't they? They're real different, right? What is income from operations? Normal recurring business transactions for what you're in business to do, right?
Yeah.
What's income from continuing operations? That plus non-operating, okay? Big difference. You need to know the difference between those, okay? I think it's unfortunate the names are so close together. And then what would you do? If this is income before tax, what would you do next? And you're right. If we don't have anything below that, that's just net income. You know what? We don't call it operating income if there's no non-operating. We just call it income before tax. Make sense? And then we get net income after you take out the tax. Always there's tax, okay, we know that, okay, some things are for sure. So what's that gonna be? Income tax what? Seeing as this is a major expense of doing business, it's an expense, right? Income tax expense. Or provision for income tax, still income tax expense, call it provision. And then what's that after that? If I have nothing below it, it'd be net income, you're right, okay? But if I have discontinued operations or extraordinary items, what do?
Net income from continuing operations.
You got it. Net income from continuing operations. You need to know what that is. Nico, people know what that is, okay? All right, so some people, when they analyze companies, like to use operating income, right, guys? Some people like to use net income before tax, right? Or, that's this one. Some people like to use net income from continuing operations after tax. And you don't have to say after tax, it's obvious it is. Now, if we have some things below here, though, you need to know what people are using when they analyze their company. Comparing apples and apples, comparing different companies. What comes after that if you have? What goes first? Discontinued operations. And tell me what we're going to do. In parentheses, we're going to say what on these? Net of tax. If it's a loss, it's a tax what? Loss would increase our income. Loss would reduce our income, but it also reduce our taxable income. So it would save us what? Taxes, right, guys? So if the loss saves you taxes, you'd be net of tax what? Benefit, right? But if it's a gain, net of tax expense, right? Make sense? You know, if you have more, you have a gain, you have some tax expense. That's all. Reduce the gain. Okay, if you either reduce the loss or reduce the gain by the amount of tax. This is going to be in two separate categories. What are they going to be? From operations, and what that is from the beginning of the year to the time when you shut it down, right? To the time when you make the decision to shut it down. Okay? So that's normal operations up through the time when you made that decision. That makes sense? So you take the revenues less the expenses for whatever your discontinued operation is, and that's going to be it, okay? And then you're going to net it of taxes, right? Take the tax impact of that. That intra-period you read about now, right? Intra-period tax allocation is putting some taxes here, putting some taxes here, everywhere you need tax, huh? Okay? And this everything has a tax impact. Same thing with the retained earnings items that we're going to do, okay? That tax is allocated across it, okay? Because it's your total tax return, and plus your amended returns if you have any, right? It's your total tax has to be allocated to different things. And there's a variety of ways of doing that, a couple of ways at least, and we'll do that in a later class, okay? It's kind of complex. All right, anyway, so we have operations, and what else do we have? Disposal, huh? Right, guys? So could I have a loss from operations and a gain on disposal, or vice versa? Sure. Could I have a gain on both? Sure. Could I have a loss on both? Sure. Both would be net of tax, okay? What comes after that? You'd add those up. Probably. You don't have to, but you add two together. Get the total from discontinued. Then what do you have next? If you have it. What's left? Extraordinary items. And guess what? They're going to be what? Net of tax. If it's a loss, it's a tax benefit. If it's gain, it's tax expense. Got it? Now when we get done with all of that, what do we have? Net income. That's it. Again, net income. Now, earnings per share. What do we do for earnings per share? We take the weighted average number of shares, and in a later class, to learn how to do that, it's real pain. Okay, you come up with a weighted average number of shares. So, you know what a weighted average is, right? We did inventory weighted average. So you keep track of when people bought stock, when people sold stock, maybe how much stock you have outstanding every day, right? You take the weighted average of it. And then we're going to do it also fully diluted shares too, which is sort of a what if. What if all the stock options and stock warrants and that sort of thing were exercised? How many shares would there be? So it's more shares. We show the earnings per share again. I'm not a big fan of earnings per share disclosure. I mean, you know, it's just dividing the number of shares into the income, right, and writing it down. And what happens is you end up with income statements where the earnings per share is almost as long as the income statement sometimes. Right? So a lot of disclosure there. and it's something that is reported elsewhere easily anyway, right? But anyway, we do it. So down here, we're going to have earnings per share, but what I want to know is, and we're just list them all, huh? What line do you start with? That's all you have to know. If you can do this income statement during the earnings per share, it's going to be really easy. And I'm going to have you do that on a quiz or a test. Don't get the income statement, all the hard part up here, right, and then not do the earnings per share. The earnings per share is nothing. And I'm even going to tell you what the weighted average number of shares is, right? So all you got to do is take the weighted average number of shares and divide it into the right items and list them all. And you put them in exactly the same order they are here. All you have to know is, where do you start? Where do you start, you guys? And the CPA exam too, of course, in real life too. So the CPA exam model is real life, it's class 2. I hope you work for people who are a lot meaner than me. It's a joke. I hope they're nicer. Okay. What do you think? I never like it when students come back and say, I've never had anybody make me work as hard as you did. And I'm making all kinds of money. I say, you're welcome. Okay, anyway, so what's the deal here, you guys? Where do you start? Can you read the chapter? Which line?
Per share of common stock.
We're going to divide the shares of common stock into what? The line, which is net income from continuing operations and everything thereafter. You mean I'm going to show an earnings per share for net income from continuing operations? Yes. Not before tax, after tax, okay? What if I only have net income and I stop there? You show one earnings per share line. Got it? Just for net income. But if you have any of these items below, what do you have to do? You have to show earnings per share for every single one of these lines. So in this case, I'd have 1, 2, 3, 4, 5 earnings per share. And it looked just the same, right? I'd write all those things down below and say earnings per share on them and show the earnings per share for each one. Is that easy or what? And easy to keep straight. It's the line. Above the line and below the line. What line do we mean? Net income after tax, really. Right? It's the line. Income from continuing operations after tax. Got it? Means the same thing, basically. We good? Everybody good with this? Okay. I have to keep reminding you guys. When you read something, know it. How many of you thought this was really fun? It's like reading a great novel. It's like watching a good movie. No, it's not. This is work. You don't get paid to read the novel, right? Unless you're an editor or something, and I bet it's not any fun. It's just work. It's not a great novel yet, but they're reading it. Okay? So, right? This is work. So when you work. After you read this, you should know what's in the chapter. I know you're not there yet, but I hope when you start your career, when you graduate from this place, you are. So you read something once, you know what it says, and you go on with your life. You have a lot to read, a lot to do. When you go to a meeting and people tell you something, you now know it, right? I had a meeting with our dean today in the hall for 2 minutes. And he asked me if I'd be willing to do something, and I knew exactly what he was talking about. I said, oh, God, do I have to? And he says, I'll give you a course release. And I said, I don't want course releases. I like teaching, so I do this. Oh, it's like you get a crummy stipend they give you to do overloads. And I said, yeah, I want triple the stipend. And then he walked away laughing. But anyway, I said I'd do it. And I didn't have to think about it very much. Why? Because I know what it is, right? It's spring stuff. So they have an economic council here in the education building. Well, my office is over here. I help them work on their general ledger, and I think one of your colleagues, our students work on it. And so anyway, they're going to move it over to the school of business, which is probably where it should be, an economic council. It's for teaching economics to grade school and high school kids. And here's the really horrible thing. You have to write grants to ask for money to fund it. I don't write grants. And I told the dean that. So what does he have to decide? Get me a grant writer and we're not doing it. Oh, just let it be small. Okay, it's still small right now. It used to be real big. It used to be over at U of L. Apparently fell and killed it. I don't know that for a fact. I don't know what happened. Okay, anyway, so you got the idea on this? This is just not a big deal, is it? Extraordinary items, you got that. Unusual and infrequent material. Okay? What's the non-controlling interest? It's the portion that the company's major shareholders do not own, right? It's the minority shareholders. Right? That's what the company does. Basically, he owns subsidiaries. So we separate their income. Okay? And they talk about earnings per share there. They go through it. Take a look over on page 178. Mine's a lot prettier, but there it is, huh?
Look at those per share disclosures down there. What line did they start with? B line, income from continuing operations, right? See that? 276. 276,000, and I guess they had 100,000 shares, made $2.76, and every line after that. It's really easy, really easy. And I keep emphasizing that because students screw it up consistently. I don't know why. So don't, okay? Don't lose those points. All right? The CPA exam, please don't lose them. All right, and on top page 179, look at that. What do people like to use? This is just amazing. 31% prefer operating income, right? 27%, what's that? EBITDA. Earnings before interest, taxes, depreciation, right? And amortization. Really? Well, some people think depreciation is not really an operating expense. Depreciation is really just using up your investment. Right? You made the investment and so yeah, it's fine. It's okay. But anyway, not very many like net income, huh? Not very many like comprehensive income either. Very few, right? Percentage-wise, okay? Even earnings before income taxes, not so much, okay? So, what's the most common one? Operating income. Okay, let me ask you this. Does it make any difference if you put something up in above in operating income? In other words, if you put it up in here, does it make a difference if you put it up in this section? Right up in here, guys. Versus if you put it down here, or much less, way down here. So what I've got is operations, non-operation. So it's not normal, right? It's either unusual or infrequent, so it's not quite normal, is it? This is what we'd expect to have in the future. That's why people like it, right? Operations. This is not quite normal, right? It's just there sometimes, not other times. And then, obviously, the ones below the line here, discontinued operations and extraordinary items. Those should almost never happen, right? Get the drift? So if it's bad news, where do you want it? Where do you want your losses? Oh, let's get them down here, right? If it's a gain or revenues, where would you really like to have it? Up here, because people think it's going to repeat, huh? What I'm going to show you how to do when we do WAC CAP-M is look at the income statement a little more critically, and we'll put stuff where we want it. A lot of companies do something called reorganization costs, and they have it almost every year. You think companies really totally reorganize every year? No. So you can't have reorganization costs every year. What they're doing is when they're closing stores that they shouldn't have opened, that kind of thing, made a bad business deal and they close them off, what they'll do is they'll plug it into non-operating. They can't get it into extraordinary, right? But they'll plug it into non-operating. So the bad news goes there. Where do I take reorganization costs and plug it? You made stupid decisions, put them up under operations, right? Unless they only have one every 10 years, fine. That's fine, that's all right. Okay, decide to reorganize the company. But if it's a continuing thing, it's continuing. It should be part of operations, in my view. A lot of companies, what they'll like to do is they'll put their interest expense down in non-operating. Really? You don't have interest expense on a continuing basis? Some companies put their interest expense under operations as general administrative expenses, down in that category, right? And with the operating expenses. Most do. Some companies like to put it down in non-operating. That's okay. They can do it if they want. What do I do with it when I'm analyzing a company? I pull it back up and take it out of operating income to get a real operating income. They have to have interest. And you got interest that's equal to 50% of your income every year. Come on, right? That's a real continuing operating expense to me. Okay, you don't have to see it that way. Okay, do whatever you want with it. You use your judgment. This is fun too.
So what's the,
Go ahead.
according to the accounting standards, what's the, how do you put it?
What's GAAP?
Yeah, what those gaps is, how you have to do it.
Either one's just fine, as long as you disclose what it is.
Okay.
Wow. That's the major one you need to adjust on. Right? You need to look for it. And it's kind of a gray area on reorganization costs too. Gray area on where you put the interest. Okay? So what people have a tendency to do if they want to look really good in their statements
is they have a tendency to plug things into that are positive under operations and negative into non-operating, right? Or you, if you can, down in discontinued or extraordinary. Do not let your clients do that, right? You've got to be consistent in how you handle things. That is true. GAAP requires you to handle gains and losses the same. It's the same type of thing, right? You couldn't take all the gains on selling equipment and put them under operations and all the losses and put them down under non-operating. That does not fly with GAAP, right? But you might, you know, if you think those gains and losses are really part of your operations, they can both go in operations. But then you should do the same thing year after year after year, right, to be consistent. However you do it is how you do it. Because if you change, we read about that in this chapter too, if you change from one method of accounting to another, what do you have to do? You're not consistent in your application of GAAP. You're changing accounting principles, right? You have to account for that through retained earnings. If it's material, right? It's not material, we care. By the way, back to, if something's not material, do you care which section it's in? I don't even care if they disclose it if it's not material. That was one thing nice about being an auditor. You'd find small errors, you could just say passing material, you don't care. You might tell the client about it, here's a small error I found. You're looking at a few thousand transactions out of 100 million. And you find a few errors and they're not material. They may not even record them. They need a new show to it. Oh, they might, right? Depends on what kind of an error it is. It's not material to them either. When you do financial statements, you're either dropping the last 3 zeros off, right? If it's millions, you know, you drop off the last 3 zeros, because otherwise you've got a whole bunch of numbers going across the page. You round everything to millions anyway, if it's in millions. If it's in hundreds of millions, you go on over, right? Billion-dollar companies, you know, they'll drop 6 digits. Okay, so materiality is a really weird thing. When I was first working, I was making, I think it was $9,600. It's exactly $800 a month. $9,600 a month. That's equivalent to about 50 to 55 now, right? Inflation. So big age on. Anyway, so I go to work and I was the Memorex audit. You know, Memorex makes tape, you know, like reel-to-reel tape, stuff like that. They make all kinds of electronic stuff now, of course. But I was on the Memorex audit in San Jose, California, and somehow I got on this job with this manager that was consolidating all the Memorex companies, and they owned, I don't know, over 100 companies. And we were doing this massive spreadsheet, putting them all together into one company. It's really fun. Interesting, I thought. And they'd never done it before. And so I'm working on this thing, and I found my first $500,000 journal entry. It was a $500,000 adjustment. And it changed their net income by $500,000. And he looked at it, and he says, "Keith, you're just doing such a great job. Way to go. That's great." And he wrote across the red passing material, and he handed it to me. He says, "Go ahead and put that in the work papers." They weren't going to record a $500,000 journal in a company that big. Right? It was nothing. If you drop 3 digits, it looks like $500 on their financial statement, right? If you drop 6, it's 0.5. Got the idea? Okay, so materiality is a hard thing to get your head around. I was making $9,600. Did I think $500,000 was material? Holy cow! Man, I thought I really found something. You change your perspective, and you realize how poor you really are. Yeah, still poor. Okay, so that's what that stuff's about. What do you do with a change in accounting principle? We have a blue box over on page 181 too. The change in accounting principle, change in estimates, and corrections of errors. Okay, and these are all going to go in the retained earnings statement, okay? Right? Is that right? Somebody tell me I just like you. No, they're not. Which ones are going to hit retained earnings? Which 2 are going on in the retained earnings statement? I've read this, right? What's a change in accounting principle? I changed from one generally accepted accounting principles to another. I did not violate GAAP and then adopt something that, you know, is GAAP. That's a correction of error, right? The error was not using GAAP. But I'm using one form of GAAP and switched to another. I was FIFO, now I'm LIFO, okay? Okay. I'm using one depreciation method to switch to another, right? Okay? So I'm going to let people know. Okay? And I'm going to record the impact. But where should it go? What what did you do at the end of each year when you're using this old accounting method? What did you, right, old accounting principle, what did you do at the end of each year with all your revenue and expense accounts that may have been affected by that method? At the end of every year, what do? You close to what? Retained earnings. So guess where you're going to adjust for all the changes to all the prior years? Retained earnings. So what would you do? I'm changing the beginning balance of retained earnings for this year by going back to all the previous years, right, and effectively restating those years, right, as though I had been using the new method in those years. Everybody got the idea? And I'm either going to increase or decrease retained earnings. Everybody got it? This is simple, isn't it? Simple concept. Okay? So you'd show beginning retained earnings, and then you'd show the cumulative effect of a change in accounting principles for that. Oh, by the way, what if there's a tax impact on that? I'm increasing depreciation, or I'm reducing depreciation in prior years. If I'm reducing depreciation in prior years, what would happen? I'm increasing the incomes of all those years, aren't I? I'm going to increase retained earnings for the cumulative effect of that. What if I'm increasing depreciation expense in those prior years? I'm reducing income, right? So I reduce retained earnings for the cumulative effect of that. Well, what else am I going to do? I'm going to have to file amended tax returns, aren't I? Yeah. Or I'll have deferred income tax. Either way, right? We'll get to later. Okay? But in any event, I'm going to change tax expense in those years too. So if you raised income, what would happen to your taxes in those years? It'd go up too. So you're going to have both go up, right? So it's going to look like this. Let's say I'm reducing those prior years' incomes by $100,000. That's only material in a little tiny company. $100 million, okay? Retained earnings gets debited by 100 for that, and accumulated depreciation credited for 100. How do I know that? I'm increasing depreciation expense in prior years. It would have been debit depreciation expense and credit accumulated depreciation spread over a number of years, right? I want to adjust accumulated depreciation upwards. So where am I going to go? I would have closed depreciation expense to what? Retained earnings. So reduce retained earnings. But let's say I'm in a 40% tax bracket. What's going to happen on my taxes? I'm reducing my income in those prior years, right? What happens? Taxes go down. By how much if I'm in a 40% bracket? 40. So this would be a tax refund receivable or less income tax payable, one or the other. Or less deferred income taxes payable if it's a timing issue between years. Okay, we'll get into that more. I know we only did a tiny bit of that in principles, right? Deferred income tax will do a lot, okay, as we go along here. What's the other side going to be, of course? It's going to reduce tax expenses. This would be increased depreciation expense here, right? But we go to retained earnings because it would have been closed anyway to retained earnings, right? And we credit accumulated depreciation. This one is, I'm going to reduce my tax liability, right? Or increase my tax refund receivable. Either way, they're going to give me the money back. Or maybe reduce deferred income taxes payable, whatever. Okay, but taxes payable in some fashion. What's this one going to be? That would have been tax expense going down, wouldn't it? But where would you close tax expense to? Retained earnings. Wow. So we just put those together, and here's how we do it. Debit retained earnings for 60. Credit accumulated depreciation for 100. And debit income tax payable for 40. Makes sense, doesn't it? Perfectly logical. God, I can't believe I did that. I just gave away probably something on quiz test or final. I don't want to spoon feed you guys like that, right? It'd be more fun to figure it out yourself. You got the idea, though? I'll do something. You got the idea? So, what about the current year's effect of the change in accounting principle? It's in the current year. You don't have to do anything. Your depreciation will be more or less in this example, right? Or, I guess, the way I did it. And your taxes will be different too, but it's just in the current year income, so you do nothing. Okay. What's different with a correction of an error? Pretty much nothing. Correction of an error is you made a mistake, okay? I made a mistake. I calculated depreciation wrong in prior years, and now I realize it. It's a mistake, right? It's not that I made a poor estimate. That's going to be a change in estimate, right? It's not going to be that I'm using a different accounting principle. I made a mistake. I screwed up in the calculations or something, right? I didn't follow that maybe, right? Didn't follow generally accepted accounting principles. So now I have more or less income in the prior years. What's going to happen? You're going to make a journal entry very similar to this. If this was a mistake, instead of a change in accounting principle, and I'm correcting the mistake, I should have had more depreciation over the years, and therefore I should have had less taxes over the years, it would look exactly the same. But we call it a prior period adjustment for a correction of an error. The other was changing generally accepted accounting principles, right? And big significant difference here, okay? Real significant difference. So what I do is I have my beginning retained earnings from last year, and then I'd adjust for any prior period adjustments, if there are any, usually not, right? And then I'd adjust for any cumulative effective changes in accounting principles, got it? And they look exactly the same. So when you read that, that's what it says, right? Previous prior period adjustment, restate prior year's income statements, any years you're showing in a large company, an SEC company, Fortune 500 certainly, Fortune 1000. They show 3 financial statements for income statement and for cash flow statement and 2 for balance sheet. You need the opening balance sheet to really do an income statement. So we do 3 income statement, 3 cash flow statement, and 2 balance sheets. Got the idea? Okay. So if you're changing accounting principle here, or you're correcting an error, what would you do for any statements you're showing? Those income statements, cash flow statements. You'd adjust those as though the error had not happened, right? You'd restate it. And then your retained earnings adjustment would go to the beginning of that 3-year span. Make sense? So, okay. So that's all they're saying here. So we restate all of those. If you're not showing the prior years, why restate it, huh? In a small company, it usually be only 2 years. A real small company, maybe just 1 year shows, right? Okay. Anyway, but what's different with the change in estimate? Big difference here. This question is real common. Nice essays on this stuff, right? Change in estimate, what's that? I made the best guess I could, educated guess, and with hindsight, I wish I'd have made a different one, right? So I am estimated that allowance for doubtful accounts should be $100,000. It turns out it should have been $250,000. I have $100,000 credit balance allowance for doubtful accounts into last year, started this year, and I write off $250 the first month. Got the idea? Somebody goes bankrupt. It's a major customer or something, right? I just get nailed. So my estimate wasn't big enough. What do? Do you go back and restate the prior years? No. Do you make a journal entry? No. Do you do a prior period adjustment? No. You don't go to retained earnings. You don't do anything except what? Made the best estimate I could. Right? So what do I have? I'd have a situation that would look like this. Allowance to doubtful accounts. What did I say? They had 100,000 in there. Then they wrote up 250. What's your journal entry for writing off 250,000 of the doubtful account? Debit what? Credit what? Debit the allowance. Because you found some of the ones that you were looking for. And you found far more than you wanted, right? But then you estimated. Allowance for doubtful accounts gets debited. Excellent. What do you credit? Accounts receivable, of course. Your receivable balance goes down by the 250 that you're writing off. And of course, you'd have a real big balance there you're writing off against it. All right. Does this make for a prior period adjustment? No. It's not a correction of an error, right? If it was an error, maybe I calculated it wrong, and I made a mistake. Now it'd be a prior period adjustment. Got the idea? So you use your judgment, okay? Use your judgment on whether it was an error or a change in estimate, yeah. Or a cumulative effect of change in accounting principle. You're using your judgment here. Okay, but anyway, if we have this situation, what does it affect? What's going to happen to me now? Because I have 150 debit in here, what am I going to have to do? 150,000 debit in here, what am I going to have to do? When is it going to hit anything? That 250, that was 150 more than I expected. Anybody going to do this at the end of the year, or maybe every month? Estimate your bad debts for that month, or for that quarter, or for that year, and credit allowance for doubtful accounts. You guys agree with that? That's the provision for the doubtful accounts. This is a write-off, right? This is the provision. True? Everybody agrees with me on this, don't you? You guys know this stuff. You got to solve it. Well, you will. Okay? What do we think here? What's going to happen to me? What if I want my allowance now, I think, oh, well, gee, I should have had a lot more, and this year my sales went way up, and this should really be 200. What's gonna happen now? If I want the allowance to be 200, and I got a 150 debit, how much am I gonna have to credit it for? 350. So, instead of just crediting it for 200 for the current year, I get to credit it for 200 for this year and 150 for last year, don't I? So last year, I probably didn't have very much debit to bad debt expense and credit to allowance, did I? I've only got 100 in the account. I probably didn't have a very big debit to expense, credit to allowance, huh? But this year, I'm gonna get slammed. Okay, so what does it say? It says to do it, changes in realizability of receivables and so on, okay? All kinds of things, warranties and so on, all kinds of estimates, those are estimates, everything's estimated there. Show the change only in the affected accounts in the current and future periods. So let's say I put way too long a life on something by mistake. And I've been depreciating it for 5 years. So let's say I put a 20-year life on it, I've been depreciating it for 5 years, so there's 15 years left. And now I decide, well, really, it should have been 10 years. Do I go back and increase the depreciation on those prior years? Nope. Leave it exactly where it is, right? It's a change in estimate, not a correction of an error, right? I wish I had put a shorter life, but I didn't know, and I made the best guess I could, right? So now I know it's only going to last 10 years. So I only have 5 years left. What am I going to do? Depreciate 3/4 of the asset over 5 years, right? Because you only depreciate 1/4 in the first 5. Yeah, that's what will happen. So the current year and prospectively into the future. Everybody got the idea on this? Easy? Pretty straightforward. Okay? Doing it is a little different. We're a bunch of problems. And they show a nice example of it on the top of page 182. That's just fine. Beginning retainer earnings, there's a correction of an error, prior period adjustment. Inventory. Get the new retained earnings thing going as normal. Add the net income, subtract dividends. Okay? I love restrictions on retained earnings. How much cash do you set aside with the restricted retained earnings? Chance. None. How many assets of any kind do you set aside? None. What happens? I want to tell shareholders that we're not going to pay the dividends. Got it? And the reason is, we're appropriating for the planned expansion or whatever it is. Okay? So when you appropriate retained earnings, this is ridiculous. You got to hope that I get asked to do this, or on the CPA exam somebody asks this. It's really nice. They do. I have regular retained earnings, which are really unappropriated retained earnings. We just don't call it that. Okay? And then they're retained earnings. And then we're going to have appropriated retained earnings. So maybe this is appropriation for a planned expansion. Okay? I've got $200 million in here, and I want to appropriate $50 million, right, for my new planned expansion. Well, that's a lot. Okay, but anyway, I'm going to appropriate. I'm going to debit this one for 50. I'm not kidding. And I'm going to credit this one for 50. Now on my balance sheet, I'll show appropriated 50, and I'll show unappropriated 150. Got the idea? After I build the building, right, do the planned expansion, what am I going to do? Reverse the journal entry. Put the 50 back in here. I'm not kidding. And take it out of here. You don't need the appropriation anymore after you did the job, do you? This is 0. This goes right back up to 200. So what really happens? Absolutely nothing. It's just conveying to shareholders why you're not doing dividends. Okay? I'm not really hoarding retained earnings. Okay? I'm not keeping more than we need in the business. Okay, good. Comprehensive income, we talked about this a little bit. Maybe they do a little bit more here. Remember this stuff we did back in chapter 2 or something? We have assets equal liabilities plus equity. I did this in principles with you a little bit too. Revenues less expenses. It's net income. Types of equity we have are what, guys? Included capital, retained earnings, and everything else called other comprehensive income. Right? Other comprehensive income. Because included in comprehensive income is net income. Right? What are the other things? Oh, by the way, you know the way that you define comprehensive income? We did it back in chapter 2, didn't we? How do you define comprehensive income? By what it's not. True? Other comprehensive income is everything in addition to net income that you have, right? Comprehensive income is net income plus other comprehensive income. This is silly, right? Net income plus other comprehensive income, add the two together, and you will have comprehensive income. Well, that's defining something by what it is itself, right? Using itself to define itself. So it's kind of silly, but that's what we do. Net income plus other comprehensive income is comprehensive income. So what's happening? Our retained earnings is changing, right? By the net income, less the dividends. You agree? Income, of course, is just the income, not the dividend. That's a transaction with owners. Contributed capital is changing by what? Owner contributions, maybe buying back treasury stock, right, guys? Withdrawals, okay? And not the form of a dividend, okay? So buying back treasury stock, retirement stock, right? So yeah, so that's what contributed capital is, but that's not part of other comprehensive income. Remember those definitions for income, right? Okay? So what goes into this other comprehensive income thing? What's in there? Unfunded pension liabilities. Gains and losses on changes in gains and losses and changes in the value of currencies when I'm holding foreign currencies. Right? So I've got euros, I've got yen, and, or they have dollars. So that the exchange rate changes on a continuing basis. That's considered to be a temporary gain or loss. The exchange rates keep changing. Okay? We plug that gain or loss into other companies. It was a political compromise. Everybody wanted to show the currencies of their market values. Nobody knew what to do with the gain or loss. And if it's material, they didn't want it on their income statements. So guess where it goes? Straight into other comprehensive income. It doesn't go on an income statement. Got the idea? Same with the pension plans. We had all these unfunded pension plans. We needed to record a huge liability on the pension plans because they were unfunded. What happened was we guaranteed companies and unions, guaranteed employees high pensions but did not fund them. So I'm promising you a real nice retirement, but I'm not putting any money aside for it. Massive liability, bankrupted a number of businesses. The truck industry is just a mess. So what's happening is these companies declare bankruptcy, and then the government, federal insured retirement program, we pick it up. And those employees get 55 to 60% of what they were promised. The taxpayers are paying for it because the companies don't exist anymore. So we changed the laws on this stuff. Used to be we had what were called defined benefit plans. So you were guaranteed a certain retirement check every year, no matter what happened in the stock. Now what we have are defined contribution. That's what I've got. Bellman puts a certain amount of money into my retirement. They match what I pay, right? We put a certain amount of money in there. I might be real rich when I retire, or I might be real poor, depending on what happens in the stock market, because that's where that money is, right? I'm taking the risk, not Bellman. You got the idea? It used to be the employers were taking the risk theoretically, but they weren't even putting the money in the retirement plan. Now you're required to actually put the money in. But everybody has defined contribution plans now. That means what? They tell you how much they're going to contribute to your plan. How much it earns is your business. Right? It's your profit. Okay? Get the idea here? So a whole lot of the money that's invested out there in the stock market through primarily mutual funds is people's retirement plans. You ever hear of a 401k? That's an individual retirement plan you can do. Right? If you're self-employed or you're working for a company or a CPA firm. CPA firms rarely have very good retirement stuff. They pay you money instead. So you should take some of your own money and invest it. I strongly encourage you to do that. When we do present value, future value stuff, I'll show you how rich you can get, you guys, and how early you can retire. If you buy a $15,000 car instead of a $30,000 car, and you keep doing that, you can retire 20 years earlier than that. Just for that. You want that Mustang bad, don't you? It's worth another 20 years. From 6 to 80. And then something. You probably live to 120 before. I hope they don't get enough advance if you live to 100. That'd be terrible. Go that long. I like my dad, did I tell you what he says though? He's got Alzheimer's, and so yeah, it's fun. It's entertaining. It is for him too. Sad, but anyway, he might as well be entertained by it. Anyway, he always says he's ready to go to any day, just not today. Tomorrow will be fine. I kind of like that attitude. Pretty good, don't you think? Good way to live life. I'm ready to go to time. Not today. All right, so look at this comprehensive income. They have these different approaches. This is ridiculous. And they talk about what comprehensive income is and other comprehensive income. Look, here's one that is a statement of comprehensive income. So they show the regular income statement is real condensed. And then they show their other comprehensive income. In this case, they have unrealized holding gain, right? On currency. You know what? Nobody does this. The author's going to say that. You know why nobody does that? The reason we have other comprehensive income is people did not want to put it on their income statement. So nobody does. Nobody wants to do that statement. Almost no bankers do. Two-statement approach. This one you have the regular income statement, right? That's on one sheet of paper. On another, on page 184. On the other sheet of paper, right? Another sheet of paper, you start with that net income, and you show your other comprehensive income numbers. There can be more than one, of course, right? It could be a number. Okay? Well, the other thing is available for sale securities. Remember that from principles? Available for sale securities. Trading securities, the gain or loss at the income statement directly, right? Available for sale securities, the gain or loss goes where? Other comprehensive income directly. Why? If you have a whole bunch of holdings in the stock market, the bottom falls out of the stock market, right? Goes down by 50% or something, which it did right at the end of George Bush's administration, right? Obama's been a wonderful president because he doubled, tripled the stock market. It went way down and it went way back up. I doubt either one of them had anything to do with either one of them. Okay, really, I doubt it. The economy kind of just does what it does. But what really caused it was what? Subprime loan, yes, was the last thing, right? That was a huge dip. But anyway, so it's recovered, it's doubled, and it's doubled again, right? Well, not when it came in a little bit, it was 6,000 down, went at 12, then 18, and now it's back to 17. But still, been pretty good for 7 years, I guess. But it was horrible the year before, it went down by 50%. Anyway, when it went down by 50%, what happened? A whole bunch of companies had huge losses. Now, they wanted to show the fair value of those assets on their balance sheet. Do they want the loss on their income statement? No. Where did they put it? Other comprehensive income. By the way, you think it would bother people when the market's going up to put the gain on their income statement? No, but you don't get to put the gain on your income statement and the loss on other comprehensive income. They both go to other comprehensive income. So available for so short-term and long-term. Remember that stuff, guys? You think I'm nuts. Investments in other companies' stocks, right? And bonds, right? They're more than a few weeks, trading securities a few weeks or less, and more than a few weeks up to forever, right, is available for sale. So where do all the gains and losses end up? All you have to do is say you're going to hold it for more than a couple of weeks. They don't go on your income statement. Got the idea? They go in other comprehensive income. So that's the other big one. Anyway, so they show that too, but nobody does that either. What do they do instead? Over on page 185, do this much longer, really, statement of stockholders' equity. This is a real short one. But notice they've got retained earnings, they've got common stock, and they have accumulated other comprehensive income. There'd be more columns because there'd be additional paid in capital stock, deferred stock, additional paid in capital on that. So there could be more things. There could be appropriated and unappropriated retained earnings both. So it gets real wide if it pulls out a page, right, on these things. But what did they do? They got the accumulated other comprehensive income to the extent possible. So do you want to read the stockholders' equity statement for a company? Oh, yeah. That's where the unfunded pension obligation really ends up. The obligation's on the balance sheet, but the expense is going to be, got it, losses are here. The stock losses are here. And then on the balance sheet, of course, in either event, any of these three that they do, you show the accumulated other comprehensive income separate from common stock and retained earnings. You got the idea? Right? Just doesn't run through the income statement. Not a big deal. This is kind of interesting at the bottom of 185. They're still working on this thing. It's been a long time. But GAAP and IFRS are working on a project to improve the usefulness of the statements. They are going to redo all the statements. And there's been some stuff coming out on that. The Europeans tend to put non-current assets versus than current assets. Upside down, we think, right? Same with the liabilities. I think they're probably right. Which investments are more important to you? Cash and accounts receivable and inventory, or property, plant, and equipment? Investments in other companies. You know, maybe the long-term ones are more important. They're right. Which are going to be the bigger liabilities, typically? Long-term debt or current debt? Probably long-term. And which ones are you worried about
you know, paying off? Well, both, of course, but as long as your current assets and your current liabilities are appropriate for each other, right? That's not as big a deal as worrying about long-term, how to use those non-current assets to generate enough income to pay off that debt and, you know, generate some retained earnings. So maybe they're right, I don't know.
Anyway, so there's some stuff coming down the road, but what they're gonna do is, 1 and 2 here is important to know. At the bottom of page 185, disaggregate information so that it's useful in predicting an entity's future cash flows.
Oh, yeah, we both want to do that. Get those future cash flows, and we also want to be able to predict the uncertainty, right? How much, when, and how uncertain, the risk level. We have to start with that, yeah. You know, if you predict future cash flows, how much and when, and how risky they are, you can value it. You can value anything this way, okay? So we do some of that stuff, of course.
Okay. So it's a joint project. We are cooperating. Why do you think the U.S. has not adopted international financial reporting standards yet?
Why didn't we just adopt it? 100 other countries using them, we weren't. Us and China. That's right. China's totally behind. Although more and more they're using international financial reporting standards because they're becoming more capitalist over time. We're good for that, right? Get a little bit of both. What do you think? Why didn't we adopt IFRS? Mostly politics. The accounting profession would like to do it. New York and American Stock Exchange would like to do it. Did I mention this to you guys yet? Companies started threatening the U.S. stock exchanges that they weren't going to list with me anymore. I mentioned that? Yeah. Okay. So then there's a lot of pressure, huh? Because they don't have to list on our stock exchange. They can list wherever they want. Well, our stock exchanges weren't very happy, right? Our stock exchanges are huge. New York and American stock exchanges, you know, they're huge. And they want all the major companies with them, all the international companies. Well, the companies can pick anything they want. So what they did was they started allowing them to do what? Use IFRS to be listed. Used to be, you couldn't against their rules, right? So now you can use either one, right, or both. But it's still a pain for the U.S. to have different standards. Yes. Is it a problem for our economy in terms of accumulated capital? Not so much yet, because we're still big enough. But as the rest of the world economy grows, and ours is growing too, but not as fast, of course, right? They have so many more people and so many more natural resources. Yeah, you know, our economy is maturing, and theirs are still growing exponentially, right? India and, you know, places like that, China. Okay, so what's going to happen? And Africa's going to, right? It's going to be huge. Okay, and when this happens, we're going to be a smaller portion of the total pie. Should we do things our way because we just feel like it? Probably not. And why did Congress not want to adopt it? And therefore the administration too. Political pressure, right? We're not going to let the French tell us what to do. I think it's the biggest thing. And it's just ego, right? Mostly, I guess, ego. I don't know why we wouldn't change. For a while, it was really valuable for you to get really knowledgeable about IFRS and U.S. GAAP because you could do the conversions. Conversions are disappearing. So those people, that's an interesting thing too. They developed this real specialized skill that was really useful. They do both gaps, and they were consulting with people and getting big bucks for converting from one to the other and explaining how things work. And that wonderful skill they developed is just disappearing. Is that a big problem? Not for most of them, because they're bright people. What would they do? Learn something else, right? Develop something else. Plus, they got their career going. They made a whole bunch of money while they were doing it. It's okay. Used to be, if you didn't understand anything about IFRS, the firms weren't interested in hiring you. You still ought to know what it is, so they probably still wouldn't be interested in hiring. Are we supposed to leave now? I haven't even started the other chapter. God, this is terrible. Oh, well, you'll read it. We got another day on chapter, well, first day now, on chapter 5. Recommendations. Did we have a review day before they put us in, or we just do this quick second?
Monday.
We have 2 more days then?
Before class on Monday.
Oh, before class on Monday, we're going to do one? Oh, thank you for telling me. Okay, I've got it on my schedule. You guys have it on your schedule too? Come if you can, try to record it if not, right?
Is there,
Monday before class?
yeah, is there a room?
It's probably 314 downstairs, 214. 214 downstairs. Oh, so we won't be able to record it. Okay. Show up if you can. Do the cash flow statements. If you haven't done those for a while, I have some cash flow statements out on Moodle. Look those up. It's the same ones you did in principles if you had my class. Do them again.
right? Do those and make sure you're still wired on how to do a cash flow statement, okay? And I'd be happy to work through something like that. Did I screw it up? This? And then mark it wrong. And that'll be half a point more. You have to track them though, and if they add up over the course of the course, right, let you know. You know what I mean?
I just want to let you know that there's a possibility, like it's of either neurosurgery next week or incorporated. Yeah.
Anything serious?
No, yeah, just to fix ACL and stuff. Or I'm not gonna have it at all, but I'm not gonna know till Monday morning. So Monday I can let you know for sure what's going on.
When do we have a footage? Not for a while.
Wednesday. So.
That's all. We're gonna drop. Hopefully, you can't get well without it. Yeah. You want? Oh, jeez. Did everybody get their test?